Good afternoon. It's Friday, May 1st. I'm Kent Kramer, the Chief Investment Officer at Foster Group, and this is our special weekly market update. For those of you who may be less familiar with Foster Group, we're an independent registered investment advisor based in West Des Moines, Iowa, with an office in Omaha as well. We get to serve over 1,400 clients in states around the country, and the people who we get to serve include institutions, individuals, and retirement plans. Today, we're going to look at just the week in review, but also we'll look at the month of April, and then we'll briefly look at the difference between the economy and the way we measure the economy and also the market and how maybe those two aren't quite as equated as we think. But first, let's take a look at the news from the last week. And this gets at some of the economic data that we saw starting to appear kind of midweek and even today on Friday. But what we've seen is the slowdown in economic activity that people expected. Well, it's being borne out by the statistics that are coming out. U.S. GDP fell by about 1.2%, or an annualized rate of 4.8% in the first quarter. Not wholly unexpected. That's what people thought beginning late February and then really through the month of March with the kind of shelter-in-place rules and the slowdown in the United States. The expectation was GDP would definitely start to fall. Another measure was consumer spending, and in March, consumer spending fell by a record of 7.5%. That's the largest amount that it's ever fallen, but that statistic really only goes back to the mid-1950s. Outside the U.S., Eurozone GDP fell by 14.4% annualized rate, so a pretty significant fall there as well. Again, not unexpected, but these are the first time we've actually seen numbers bearing out what people thought was actually going on. Then we look at kind of the unemployment numbers. They continued to go higher, although not quite as high in terms of new claims in the last week. More than 30 million Americans have filed claims since mid-March. Most states now are seeing those rates kind of trending lower, but they're still seeing new applications, just not as many of them as previous weeks. Along with that, though, many states across the U.S. are announcing their kind of reopening plans as the virus-related statistics across the country in some cases are plateauing, and in many areas are showing declines in both new cases and hospitalizations, which is part of the White House's kind of guidelines for states reopening, as they need to see those numbers trending in the right direction and hopefully trending over a week or 2 weeks of time. So markets for the week were really up and then down. And by the end of the day today, it looks like they'll be about flat for the week, maybe slightly negative. What we did on this chart again is we're showing the U.S. stock market, which is the light blue line, the S&P 500, the U.S. bond market, which is the yellowish orange line, the aggregate there. And then we also show stocks outside the United States, which is the purple line. And I threw in this week U.S. small value stocks. And the reason I threw that in was because there's always an outlier kind of return each week, so an asset class that seems to be doing particularly well or particularly not well. And this last week, U.S. small value companies who had done really poorly in the first few weeks or so of this correction and bear market period really started to make a strong comeback. They were up by almost 15% in the middle of the week before kind of losing those gains here at the end of the week. The reason I included that is just to show the volatility and the disconnection sometimes between asset classes as we go forward. This is something that we'll look at from week to week as we go along, just seeing which asset classes are performing relatively well and which ones are slower to respond. Kind of a tale of 2 months here as we close out the month of April. I wanted to just compare the April returns for the different asset classes that we track as well as the March returns. And you can really see the stark difference. If you look at the Russell 1000 there, U.S. large companies, April, they were up a little bit over 13% after being down a little bit over 13% in March. That's not a typo. Those are exactly the numbers for the 2 months. The Russell 2000, again, had those are small companies in the United States, had a really rough March, but made a nice comeback in April. You can just kind of go across the board there. The one that I think is particularly interesting is the Bloomberg Barclays Aggregate Municipal, which was actually negative in both April and March and is negative for the year to date. What that shows is the credit quality in municipals, the kind of the worries about municipalities, cities, and states in terms of their finances. And some of those bonds that they've issued have just taken a little bit on the chin here, but they've started to come back. Year to date, they're almost back to break even. This is not unusual. We talked about this a few weeks ago. This was the same kind of pattern we saw in 2007, 2008, where initially there was some pressure on municipal bonds, and then they began to come back a little bit later, kind of trailing the overall bond market, which you can see in the Bloomberg Barclays aggregate US bond, which again was positive in April after having a negative month of March. So looking at those kind of numbers, one of the things that people have been asking in April is, well, is this the recovery that means we're out of the woods? In other words, have we started a climb out where we're not going to be going back to those lows, or are we kind of through this really bear market period? The Wall Street Journal had an article this week where they put up 3 charts, and we'll look at these 3 charts here. I want to kind of talk through each line. The brown line is what they was called the 2008-2009 dead cat bounce, which is really a nice term. What they're describing here is a period starting in November of 2008, where it looked like the market was really starting to recover. So by the end of December, right here, it looked like the market was in full recovery mode. And then moving into January and into February, things went down again pretty significantly. As a matter of fact, in January of 2009, stock market fell by 8.4%. And then in February, it fell by another 10% before it finally started to rise in March of 2009. So that's the light blue line. The light blue line is a period that's starting on March 9th, 2009. That ended up being the true bottom of the market in that last recession. And you can see kind of what that looked like. So what the writer was saying was, well, is the recovery we're having right now in the stock market, represented by the darker blue line, is it going to kind of take the path of the first recovery, which then had some downward pressure before it ultimately came back, or are we on a more long-term permanent recovery? Of course, the answer to that question is no one really knows. What we're seeing right now is a variety of economic data that people have been anticipating, but the question, of course, is going to be, will it continue to be what we expect versus what we not expect? A lot of the discussion, too, has been around, are we going to experience a V-shape or a U-shape recovery? And what I would encourage you to think about when you listen to people on the news or you read about that is to really try to determine, are they talking about the economy or are they talking about the stock market? Because the economy is a much more gradual kind of move. You think about the numbers we saw this week. The US economy, GDP shrank by 1.2% for the quarter, 4.8% on an annualized rate. 1.2% is a pretty big drop in GDP. 1.2% drop in the US stock market is nothing. We see that on a daily basis. And you can see that in this chart. The red line, which really looks jagged here, that's representative of US stock market movements per quarter, up or down. The gray bars and kind of the blue lines there, those represent US recessions. So the period, how long did the recession go? 2008 to 2009 was a longer recession, went almost 6 quarters. But if you go back in the early 90s, some of these recessions were 3 quarters. Back here in 1980 was 2 quarters. The thing I want us to notice in this chart, though, is the way the stock market begins to recover before the recessionary period is officially over. Kind of brings us to the question of where we are right now. Is the stock market right now on its way up, meaning the recession is basically going to end soon? Or is this kind of one of those initial moves up, but the recession still has a ways to go? Again, we don't really know for sure. We'll know over time. But the thing for investors to remember when they think about economic data and stock market data is, if you're talking V-shape or U-shape, remember the longer term numbers when it comes to recession and GDP, usually that's what people are talking about when they mean a U-shaped recovery. Stock markets tend to move in V's, and you can really see that in this chart. The other thing I wanted to make a point here is the economy is not the market. Oftentimes, the US stock market is moving in advance of what's actually happening in the economic data. And the reason for that is investors kind of know what's going on. They look into the future and go, hey, we think things are getting better, so we're going to start investing back into stocks now in anticipation of that better news in the future. And what you can see when you look at previous recessions in this chart is you can see that during the actual recession, stock market performance has actually been positive, which I think sometimes is counterintuitive to people. They think, well, in the midst of a recession, aren't stock markets negative? Again, what's happening is the stock market is anticipating usually what's going to happen. So the stock market will usually begin to go down before the recession begins, and then it will start to recover and go back up before the recession is over. So during the recession, it's not uncommon, especially in shorter recessions, to have positive stock market returns. You can see in this longer recession, the last one, 2007 to 2009, we did have negative, significantly negative stock market returns because that recession was very, very long lasting relative to other recessions in history. A quote that I really liked was this one from Daniel Kahneman. A lot of people want to predict about what's going to happen, and certainly what's happened recently has been a surprise. He talks about investor overconfidence or just individual overconfidence in terms of our ability to forecast what's going to happen in the future. He said this. He wrote, "The correct lesson to learn from surprises is that the world is surprising." So oftentimes we think, well, I'm going to learn from this lesson. I'm going to learn from this lesson of the past, and it's going to help me predict what's going to happen in the future. What his point is, be careful about what you want to predict, because oftentimes the thing that we need to learn is just the world is surprising. And each time that something happens, it may be surprising in a different way. Very, very hard for us to predict. The reason it's important for us to think about the world as surprising is we want to prepare for a variety of possibilities, which means before anything happens that is surprising, we want our investments and our financial plans to anticipate both positive and negative potential short-term and mid-term outcomes so that our long-term plans are not derailed by things like the Great Recession and a really bad housing market, or a virus that turns into a pandemic and creates all kinds of economic distress, at least for a time, around the globe. One of the other thing about this quote that kind of reminded me of something coming in terms of surprises is, well, 2020 is an election year. There's all kinds of surprises when it comes to elections. We certainly saw a surprise in 2016 with the election of President Trump. We're fortunate to be acquainted with a very, very good pollster, Ann Selzer, and Ann is going to be holding with us a virtual webinar event, and we're calling it Financial Resiliency in a World of Political Uncertainty. Certainly in a year like this one, things are uncertain. They're uncertain both from a health standpoint, from an economic standpoint, and now as we kind of move more heavily into a political season in terms of what's going to happen with the elections in November, of course, the question is, what is going to happen in November and how would these elections come out? And based on what we might think about the political environment today, are there some things we should be doing to examine and prepare financially to make sure that we're in a resilient position regardless of that political outcome? You can see the registration details here. You can go to our website, fostergrp.com, and register for this event coming up on Thursday, May 14th. I'll be interviewing Ann. Ann will be doing a presentation about 10 things to know about what's happening in American politics right now. Again, she's a very, very, very well-known pollster. She's been on Bloomberg. She's been associated with CNN. She's done the Iowa poll here in the state of Iowa. Just a highly respected pollster, very enjoyable person to talk to. I think if you're able to attend, you'll enjoy it and learn a lot. So again, enjoy doing these things once a week with y'all. Hope you enjoyed this presentation. If you have any questions, please let us know. We'll try to answer them as we can. Otherwise, hopefully we'll talk to you next week. Thanks for attending today.